On behalf of HSBC Mutual Fund, I'd like to warmly welcome you for today's webinar. I'm Ankur Thakur, Chief Business Officer of HSBC Mutual Fund, and it's a pleasure to be hosting today's session in collaboration with World Gold Council. Uh, Over the years, we all have seen the evolution in terms of gold being traditionally a safe haven to becoming part of the strategic portfolio. And in today's session, we would aim to explore the evolving role of gold, understand the key drivers in terms of shaping the outlook for this metal, discuss how it can help our investors effectively integrate that into their portfolios. We today have experts from World Gold Council who will share their insights and perspective on this asset class. So let me first introduce our speakers for the day. We've got John, who's Senior Market Strategist at World Gold Council. John is a strategist for Europe and Asia and is based in London. He joined the World Gold Council in 2017 and working closely with the research team is responsible for developing strategy about gold and engaging with all aspects of gold markets. He is also one of the principal spokesperson for the organization. John has over 35 years of experience in gold industry and has worked for gold mining companies in production and evolution, for investment banks as an equity analyst and gold strategist, and at an asset management as gold strategist and portfolio manager. John has a degree in mining engineering from Royal School of Mines, a constituent of Imperial College London. We also have with us Kavita Chako, who's the research head India at World Gold Council, and Ms. Sheila Kulkarni, who's head of market development and institutional investor relationship at World Gold Council. Thank you all for joining us today. Without further delays, I'll hand over this meeting to John, who will take us through a presentation and give us his outlook on gold.
Thank you very much, Ankur. Let me just share my screen. I think it's that one. I was joking before. We've been doing these Teams and Zoom meetings now since COVID. You'd think we'd be quicker at getting it working, but there's always seems to be some fumbling. I hope you can see my presentation there.
Yeah.
Perfect. Okay, so let me kick off. I'm going to talk about gold. I'm going to talk about gold from an investor perspective and from a longer-term strategic perspective. We very much believe that gold should be a strategic allocation in pretty much every investor's portfolio. I'm going to explain to you why. As a brief introduction, when I come to India, I'm always very pleased that everybody seems to know the World Gold Council, probably because we've been active in India for such a long time. That's not true everywhere in the world. But we're a membership organization, a non-for-profit, set up about 40 years ago by gold mining companies to promote gold. And we do that in a number of ways. We work with regulators and governments to make gold more accessible. We sometimes develop infrastructure for the gold market. And we produce a lot of research, data, tools, and strategy. And I'm part of the investment team. I work very closely, as you heard, with the research department, taking their numbers and their words and turning them into stories about gold. And that's the story I'm going to tell you today. Now, I do apologize. I haven't been able to update my presentation because I've been traveling. I just got back from New York about an hour and a half ago, so I'm a bit tired as well. So sorry for that. So this is from a few days ago. The gold price is slightly out of date. We're about $200 lower than where we were before. But it doesn't change the overlying story. We've seen gold perform extremely well over the last 5 years. Before showing more volatility over the past 6 months, and we're in the midst of that of a volatility event in gold at the moment, provoked by the ongoing conflict between the United States, Israel, and Iran, and the movements that we're seeing in fixed income markets, inflation expectations, etc. We'll talk a little bit about that at the end. Putting it in more context, though, if you look at gold's performance in US dollar terms in 2024, we saw in excess of 65% returns. That's the second strongest gain in gold that we've seen since we came off the gold standard, only eclipsed by the performance in 1979. And it actually comes on the back of 3 strong years of performance, about 19%, about 26%, and then 67% last year. In terms of all-time highs, the blue dots on the left-hand chart show you the all-time highs that we've seen in gold. And yes, we did have a few of those during COVID, the early stages of the COVID pandemic. But really, since 2024, gold has been on a one-way ride, hitting a succession of all-time highs. We've seen actually 11 all-time highs so far this year before the recent correction has come through. Up to January, gold was the best performing asset class in the world. We've seen obviously some profit taking or decline since then, but it's still performing well, particularly compared to other assets, which are also suffering from the sell-off associated with the conflict in the Middle East. So some background slides on gold. It's an unusual commodity in as much as it has 2 different types of drivers. One set of drivers comes from economic prosperity, growth, money in people's pockets, driving jewelry demands, driving the industrial uses for gold, which are almost all technology. But on the other hand, it's also driven by investment flows, which are partly driven by risk and uncertainty, partly by diversification. And then central banks are buyers too, something which has changed quite a lot over the last 15 years. It's a very global market too, both in terms of demand, which you can see on the left-hand side here, but also supply. I think the thing I would take away from this is that emerging market demand for gold is now about 70% of consumer demand. Industrialized countries used to be a much bigger component of this, but the incredible economic growth that we've seen from emerging markets, particularly India and China, has turned the gold market on its head over the last 30 years, such that we're now very much dominated by demand from rapidly growing emerging markets. On the supply side, you can see that mine production is spread throughout the world. Africa, the most important continent, and Europe, the least important. As Europe has gone sort of post-industrial, people don't explore for many commodities to mine or extract in Europe anymore, and gold is very. But other than that, it's very well spread. So a new chart that we put together for this presentation, something that I'm very excited that our research team has shown, is almost like a one-chart summary of the gold market over the past 35 years. And it's worth having a look at this for a moment. If you look at the big purple bars in this chart back in 1990, that represents jewelry demand, jewelry fabrication. And you can see how when the World Gold Council started, when I started my career in gold, this was a market that was dominated by jewelry demand. The green bars represented flows from central banks. So central banks were sellers of gold right up to the global financial crisis. Technology was a small but important component of it, as it has remained ever since, but only a small component. But back in 1990 or 1995, you can see that investment demand was a very small component of overall gold demand. What's happened since then is that we've seen a big change in the makeup of demand for gold. Central banks turned buyers. Investors became a much bigger component of the market, and both of those things happened around and after the global financial crisis. Jewelry demand has declined substantially. Although it's still an important component, it's no longer the dominant category. The other thing to have a look here is at the blue bars which appeared around 2004 and have continued ever since. That represents investment not in physical gold in bars and coins that you can pick up from a shop and take away, but rather in exchange traded funds. And the ETF story has been a positive and strong story for the gold market. We have seen some years of outflows of ETFs, but in general, ETFs have been a big component of investment demand, and increasingly, as you will see, becoming more focused on emerging market demand, particularly from Asian countries. Final introductory slide, I would say, is to think about gold as different from every other commodity. Most commodities you take out of the ground, put in a refinery, turn it into a product, and destroy that product through its use. So people measure stocks of oil or energy products or months of consumption. In the case of gold, we take it out of the ground, we refine it, we turn it into products, and almost none of it goes away. All the gold that's ever been mined, except the small components that have been lost, but all the gold that's been mined, something like 220,000 tons, is available to the market. Sure, you might have to push the price up a lot higher to persuade people to sell their jewelry or sell their investments, but you're never going to run out of gold. And if we were to stop mining gold completely tomorrow, there'd still be enough gold around for us to have to use as we wish, although the price might be a bit higher. So I'm going to start off with the investment side of this presentation by talking about the strategic case for gold. This is a short presentation that we use when we're speaking to investors, asset managers, high net worth individuals to explain why gold should be a part of their portfolio. So gold contributes to an investment portfolio in three ways. First of those, through returns. Second of which, and probably more usefully, is the diversification benefits that gold brings to a portfolio. And then finally, as a source of liquidity under certain circumstances. Now, I've shown this chart before, and I apologize for duplicating it. So let's move on to the next one. In the case of returns, we've taken 20 years, 15 years, 10 years, etc., returns for important investment assets, particularly from an Indian context. And you can see that the returns in gold have been in line with or better than pretty much every other asset class available to investors pretty much all of the time. Now, there are certain exceptions. Sometimes equities do particularly well. And if I do this graph in the United States, we find that US equities have tended to outperform gold over the longer term. But that's really only the only major asset class that has. But that's not a problem. This is not a competition saying that gold is better or worse than other asset classes. The argument we make very strongly is that gold is a complement to other asset classes you hold in your portfolio. And one of the ways you can see this is to look at correlations. So you think about building a portfolio, you want to have the majority of your assets in things that are going to grow. So equities, equity-like investments. But you also want to have some diversification to protect you when equity markets sell off violently. And this is where gold plays a particularly useful role. On average, gold isn't correlated to equities, neither positively nor negatively. And you can see here the Sensex returns over the last 20 or so years, and the correlation between gold's returns and the Sensex returns is basically zero. Okay, that's fine. So you're adding an uncorrelated asset to a portfolio. That's useful. But gold's better than that. Because if you look at what happens when equities fall rapidly, 2 standard deviations down or 3 standard deviations down within a week, then you'll notice that the correlation goes increasingly negative. Now, this is true wherever we look in the world. Gold is generally uncorrelated, but then negatively correlated when equity prices are falling fast. So what that means is equities are down, gold's negatively correlated, so it's generally up. So having gold in your portfolio not only contributes to returns, but it helps offset some of the risks that you have in an equity portfolio. Many people tell me that gold is volatile. That's partly true. Gold is more volatile than government bonds, but then again, so is everything else. If you look at volatility in gold 20 years, compare it to a commodity index or a developed market stock market index, it's about the same. And if you compare it to emerging markets, US stocks, etc., then it's actually slightly lower. The other point I'd say is, well, from a portfolio perspective, volatility is not bad from an individual asset class. It's what it does to the overall volatility of the portfolio, which is more important. And because gold tends to go up when other stuff goes down, you can consider the volatility in gold from a portfolio perspective to be useful volatility. Gold is also a big liquid market. And we've been updating this chart for years, and it just keeps getting bigger and bigger. The volume that trades in the gold market has been increasing tremendously in the last few years. And we're getting to the stage now that about $350 billion a day trades in the gold market. And that's bigger than the US T-bill market, smaller than the bond market, but not much, but bigger than pretty much everything else. And that's really important because you want to be able to deploy capital in gold, and more importantly, perhaps take that capital out. So you need to have liquidity in the market, and we certainly get that from gold. Gold tends to perform well in the recovery periods following a big shock to financial markets, a sort of systemic sell-off. So we've looked here at pretty much all of the big sell-offs that we've seen over the last 20 years, 30 years or so. And you can see that despite initial weakness that you often see in gold when a shock happens, whether that's the global financial crisis, whether that's the failure of Lehman, whether it's the COVID pandemic, you often see gold weak first, but then it's quick to recover, perhaps the first major asset class to recover, and outperforms historically compared to other asset classes post-crisis. That's probably what's happening at the moment. I mean, history is not necessarily going to itself each time, but I'm not entirely surprised that we've seen some weakness coming through in gold as the extent of the crisis in the Middle East becomes apparent. So what do these factors do when you put them together? We have returns, we have diversification, we have moderate volatility, arguably the right sort of volatility. We have liquidity. What happens when you've added to a portfolio? So we've taken the last 20 years of performance of a hypothetical 70% equity, 30% fixed income portfolio, and then added a little bit of gold, reducing everything else proportionately. And what you can see on the right-hand chart is the risk-adjusted return of that portfolio has gone up. The more gold you add, up to about 15%. Now, this is from an Indian context. I always find it interesting that despite the strong performance of the equity market that we've seen in India over the last decade or so, the ideal allocation to gold that we find in India is one of the highest in the world. Normally, when we do this chart, we start at 2.5% gold and finish at about 10. When we do the chart from an Indian perspective, the target allocations turn out to be quite a bit higher. So that's gold in a nutshell. That's why gold should be part of your portfolio. If you had a strategic allocation to gold anywhere in the world, in this particular case, we're looking at an Indian benchmark, then you would have improved the risk-adjusted returns of the portfolio. You would have reduced the portfolio volatility. You would have increased the average returns. And we've got data which we can share with you to support all of this. Right. So perhaps more up to date, what's been happening in gold more recently? Now, we produce a document each quarter called Gold Demand Trends. Obviously, we're in the first quarter still, so we haven't written much about 2026 yet. So I'm going to talk mostly about 2025 and then project forward a little bit. The big story in gold last year, aside from the price performance, has been a big increase in investment demand for gold. You've probably heard central banks are buying gold around the world. That's been a big reason why the gold price has gone up. And that's probably true in 2022, 2023, maybe even into 2024. But in 2025, the big change was this increase in investment demand. We saw it through exchange traded funds, who added about 800 tons of gold to their holdings last year out of a 5,000 ton market. That's a big increase. But we also saw increases in bar and coin demand as well. Central banks bought a good amount of gold, but a bit less. And as you can imagine, with very high gold prices, jewelry demand fell. The final thing I'd talk about is supply. Supply to the gold market has not been growing. And because supply has not been growing, when you see a big increase in one component of demand for gold, particularly one which drives the price up, like investment, then the only place that that increase in investment demand can come from is by making room somewhere else. So where did that room come from? That room came maybe a little bit from central bank, but more importantly, it came from the decline in the jewelry market. I've put this chart in here on India specifically with this presentation. For a long time, I've referred to India as an 800-ton market. And yes, some years it's been a bit higher, some years it's been a bit lower, but it's been a very steady market over the last 15 to 20 years at about 800 tons. And if you think about what the gold price has done, either in US dollar terms or Indian rupee terms, I find that quite remarkable. The other thing that is changing, if you look at the colors on this chart, you can see that investment demand has become a bigger component of the market post-global financial crisis. So that's a theme that we've seen everywhere, but it's true in India as well. And I think that's really important because when I speak to people about Indian gold demand, the first thing they think about is jewelry. And of course, jewelry is really important, but investment demand is becoming a much bigger component. And you'll see from the dark blue bars here, the ETF demand is becoming a bigger component of investment demand. And that's probably the reason why we're having this conversation now, as lots of providers are offering ETFs in India. It's seen as a growing market, probably one which will continue to grow going forward. If we look at 2025, the remarkable increase in investment demand is shown both in physical bars and coins, but also in ETFs. Now, the bar and coin investment market is much bigger on average than the ETF market, and it's more stable. So you can see that over the last 5-6 years, we've had about 1,200 tons of bar and coin physical buying of gold bars, coins, tokens, all things like this, things you can pick up and put in your pocket and take. You can see also the growth that we saw coming through last year. So that's taken it to a level that we haven't seen over this last period. The ETF market on average is much smaller, but it swings around a lot more. And that's what we saw when from a market which had been flat to slightly lower in terms of ETF demand and supply over the last 4 years to a big improvement last year and some very strong inflows. It's interesting to me as well, if you look at those blue bars on the right-hand chart, how important Asia is becoming in the ETF market. Now, that's not just India. That represents India, China, Japan, Korea, Malaysia, all showing strong signs of growth in ETF investment. And if you look on the left-hand side, you can see how bar and coin demand is being dominated by Asia as well. It's always been an important component, but it's become much more so as particularly United States investors are buying less physical gold. And even Europe, although it's recovering slightly, buying much less gold than they did during COVID and after the global financial crisis. So again, a clear demonstration of the importance in Asia in terms of overall gold demand. So moving now to jewelry, I sometimes upset jewelry companies or jewelry shop owners by saying, I don't see anything wrong with the jewelry market. And the reason I say that is that jewelry buyers around the world are spending more money on gold each year, pretty much right the way through from 2020. So yes, they're buying less weight of gold, but they're spending more in dollars at spot prices than they were. So to me, this is a market that's responding to higher prices by buying less, by buying fewer pieces, by buying lower carat pieces in some market, by buying fewer pieces. But lots of indications people still want to buy gold jewelry and are prepared to spend more money on it than they have done in the past. You can see why central banks have dominated the storytelling about gold over the last few years. The big increase that we saw in central bank purchases that took place in 2022 doubled the amount of gold that was being bought by the central banking community. Now, that's slowed down a bit in 2025, and I'd expect it to slow down a bit more in 2026. I think the reason for that is quite simple. The gold price has gone up a lot. If you're a central bank and you were targeting a certain proportion of your reserves in gold, and you've been buying gold, that's helped. But so has the fact that they've gone up so much in the last 3 years. So a lot of central banks are now finding themselves with much higher allocations to gold than they would have expected. And I think at the margin, that's causing a slowdown in some purchases. It may be triggering some sales as well. Singapore is an interesting case here. They bought gold a few years ago, put a relatively small allocation into their portfolio, 4 or 5%. And I was excited about that. Singapore's a big central bank. It's got lots of foreign exchange reserves, not very much gold. I thought it might be the start of a big buying campaign like we've seen from other central banks. But it turned out not to be the case. What we've actually seen is in the last couple of years, we've seen Singapore selling. And I think what's happened there, because they don't tell us, they made an explicit allocation in gold. And now that the price has gone up so much, they're simply rebalancing. So that might be happening or about to happen in other countries as well, where the gold price has gone up a lot. So we expect central banks to continue to buy good amounts of gold, but perhaps at a lower rate than we've seen before. You can see on the next chart just how much the percentage allocation gold has changed over the last few years. And the advanced economies haven't really bought gold. That's just a price appreciation factor. The emerging market economies have bought a lot of gold for the central banks, but you can see that this is mostly price. It's not so much the buying that's increased it. Flipping over to the supply side, mine production, about 3,600 tons, probably hit an all-time high last year. We always get the production data a bit later than everything else, and there may be some revisions here, but it looks like gold production hit an all-time high. But the bigger story here is gold production hasn't really grown since 2018. Mining companies are struggling to increase output to take advantage of these very high prices because it's getting harder to find new gold deposits, harder to permitted, in other words, get permission to build and operate these mines. It's getting more difficult to finance them. They're expensive. They can be in very remote parts of the world and remote parts of countries. And as I say to people, and I'm a mining engineer, so I understand this, obviously, mines aren't like factories. You can't build a mine and expect to run it forever. Eventually, you reserves at that mine. So you need to keep finding new mines, new projects all the time, just to keep mine production flat. And the gold mining companies haven't been very successful about that. So despite the fact we've got record high gold prices, record margins, record levels of profitability. The mining industry is struggling to grow, and that probably continues. The other factor is the recycling of old jewelry. Normally, we would expect when the gold price goes up rapidly that we would see a huge increase in the recycling of old jewelry out there. And that hasn't really happened. If you look at the difference in the line between the blue line, which is the increase in recycled gold, and the gold price in yellow, you can see that recycled gold has underperformed what we would normally have expected. And that's the other important factor. Because mine production takes a long time to increase, recycled gold can come back really fast. So another illustration, I think, that we're in a supply-constrained environment. So what about this year? What are we expecting? Well, we produce an outlook document in December each year, available on our, and we try and estimate what's going to happen to the various components of supply and demand. I joke with the research team, it's almost out of date before you print it because the gold price has always gone up by more than we were expecting. And that is actually part of the problem we've got here as well. But I think the overall themes are probably about right. Investment demand will continue to be the main driver of gold 2026. I think fabrication demand will fall again because the gold price on average is probably going to be higher than it was last year. That will have an impact on jewelry demand. I think also there is a risk that central banks buy less gold than perhaps we're expecting here. And we have seen a couple of announcements from some central banks that they might even sell gold this year. Ghana, Tanzania have been recent buyers of gold in the last few years. They've spoken about taking advantage of some of the higher prices. So central banks will still buy gold, we're confident of, but perhaps less so than last year and than we were expecting in this document. Finally, on the supply side, we probably see a bit more, but then again, we've said that every year for the last few years and it hasn't really come through. It's going to be an investment-driven market and mostly drained. And I think that's the theme that you need to remember. So look, summarizing where we've come from, gold has hit a series of all-time highs, 2024, 2025, the first part of 2026. Main driver of this investment demand has been a pickup in the risk and uncertainty. And 2025 and the early part of 2026 has mostly been about a pickup in risk and uncertainty from the United States, whether it's economic policies, whether it is tariffs, whether it's geopolitical issues. All of these things have driven gold higher. What we are seeing, though, is as investment has taken up a bigger component of demand, and as Western investors have come back to the market in 2025, we're going to see more volatility. Gold went up from the beginning of 2024 right through to October 2025 without any material pullback and decline. October saw a correction. End of January seen a correction this year. And then obviously the last few days, as the extent of the crisis in the Middle East becomes more apparent, we're seeing more of a correction. You should expect this. When investors own a higher proportion of gold demand, you will get more volatility. But that may present opportunities as well. When the gold price keeps going up, it's easy to think, oh, I'll wait for a correction. And if you don't get one, difficult to get an allocation sometimes. That's, I think, the story of 2024 and most of 2025. Now we're in a situation where you will get corrections in gold. We've seen it effectively 3 times in the last 6 months, probably continues going forward. But we do expect investment demand to continue. Because if you look at the factors that have been driving investment demand over the last few years, they're going to continue. We can see geopolitical stresses around the world. The concerns about the US dollar and diversification away from the US dollar is likely to continue. We're going to see slower growth. We were going to see lower interest rates. Now the risk is we get stagflation, so lower growth and higher inflation as a result of energy prices. That's not very good for economies. Historically, it's been very good for gold investors. President Trump continues to threaten the Fed. He's going to replace Jerome Powell, current Fed chair, with somebody that he picks. And I think that takes place in May. Obviously, we'll need to get that confirmed through Congress. But we're going to get a new Fed chair. That probably means that the pressure on interest rates in the United States will be lower than they should be because President Trump wants lower interest rates. And if interest rates in the US are lower than they should be, investors around the world will doubt the dollar, will doubt the treasury market. They may like the equity market, but they probably will hedge themselves against declines in the US dollar. And one of the most effective instruments for that is gold. And then finally, the last one, momentum. When gold's going up rapidly, it draws a lot of money in at the moment. And when it corrects, that money leaves quickly. Expect periods of volatility. I'm going to stop there. We can get a Q&A. Thank you very much for your time.
Yeah, John, thank you. That was a very, very insightful presentation. A lot of pointers to take in. We've already started seeing some questions in the Q&A tab, but looking at the presentation, I thought I'll start off with some of the questions which are very natural and been facing those questions. So start off with something which you just mentioned in terms of the geopolitical scenario and the global economic crisis. We moved from, say, an inflation cycle to a geopolitical tension kind of a situation. How do we then, as an investor, look gold from a financial asset perspective in an environment like this? Is there an answer to it, the way we should take the gold investments forward?
It's an interesting question. I mean, when we have geopolitical events, people often get excited about gold and expect it to go straight up. That doesn't normally happen. What we normally see when there is a sudden shock is investors may turn to gold in the short term, but if that shock spreads through the rest of the market and triggers selling pressure across all asset classes, gold is not isolated from that. It's not immune to this type of correction and this type of selling. And the fact that gold has performed so well in particularly the last 12 months, but maybe the last few years, there's quite a lot of investors in there that can take profits or reduce their exposure because they want to rush for cash. That's happened regularly or repeatedly after some of the major financial stroke economic events that we've seen in the last 15 years. We saw gold fall at the start of the global financial crisis. It then recovered in the next few months and ended the year higher, the only asset I think that did back then. We saw it in the early stages of COVID. We saw gold under pressure when markets went really crazy back in March 2020, but then traded substantially higher through the balance of the year. We saw it to a degree with the Russian invasion of Ukraine as well. So I'm not surprised that we haven't seen gold just go straight up in the current environment, particularly if you look at the performance that we saw not only in 2025, but early in 2026. I think it shows a couple of things as well. Tactical trading is really hard. It is much easier to think about investments from a portfolio perspective, from an asset allocation perspective. Have a strategic allocation to gold as part of your diversifying assets to offset your equities, and then you can adjust that strategic weighting depending upon performance. To try and work out where gold is going to go for the next $200 or the next 2 days, as it is at the moment, it's very, very difficult. And I speak as someone that's tried to do that for about 25 years, so I can speak from experience. But having gold in your portfolio when unexpected items end up in your inbox, like a war or a COVID pandemic or a global financial crisis, that's the way that you want to think about gold. It's something you have rather than you try and trade.
Yeah, well, that's a very interesting point. I just have a question as an extension to what you just mentioned towards the end. As in, you've been meeting many investors globally in terms of who invest in gold. Can you share some common misconceptions which they have when it comes to investments, gold as an investments? As one of the things you just mentioned is the war and the linkages of the price.
Sure.
Is
Another one I think is inflation.
okay.
People think that gold does well during consumer inflation. And that's not quite true. Gold tends to do much better during periods of monetary inflation. So when central banks are printing money, when governments are spending money, even if it's not turning up in headline consumer price inflation, that's when gold tends to perform well. When inflation starts to turn up in the consumer price index, that's when other commodities tending to do well, oil, some foods, maybe some base metals. So just because CPI is high doesn't necessarily mean gold is going to perform. And a great example of this was again in 2020. We saw massive increases in global money supply, massive spending by governments to fight the effects of COVID. Gold performed very well. Inflation was generally low during that period. When we got the recovery starting in the economies, we had the fantastic news about the vaccines back in November 2020. Gold actually saw some profit taking, and people were buying assets which would do well in a reflationary environment. Equities, hard commodities, industrial commodities, I should say. And then when the inflation came through a couple of years later, well, gold had already given you your protection against that by its performance in 2020. It wasn't the best. It wasn't the best hedge against CPI because it had been the best hedge already against expansions in money supply. So I think that's a misconception. If I was to talk about misconceptions that people have about gold and silver, I would be here all day. But I think those two are probably the good ones to
Okay.
start with, at least.
Sure. But in your presentation, you did mention about the emerging markets participation, particularly Asia becoming one of the large buyers of gold and the gold demand which is there. What's the trend you are observing from these markets? As in, what is the kind of gold which people are buying in this market? Is it the ETFs or
Yeah,
financial assets or as jewelry?
it's not so much jewelry, not in the last few years. Jewelry demand has been declining pretty much around the world, although, as I say, more dollars being spent on it, but buying smaller amounts. The trend that we're seeing generally is investors are buying gold through every channel that they have available to them, whether it's physical gold, whether it's gold structures, maybe futures in some cases, options in some markets, and obviously ETFs. But what I would say is one of the trends that we've recognized around the world and in emerging markets in particular is that financialized versions of gold, rather than physical gold, are becoming a bigger proportion of the purchases. And I think that's because investors in many emerging markets are recognizing that gold is not just a trinket or a thing that you buy and own and keep at home or in a locker, but that it should be part of your financial portfolio. And as emerging market investors are becoming more sophisticated and are investing more in stock exchange products or mutual funds or equities or however you define it, they're recognizing that gold has a place. Now, one of the big drivers of the increase in investment demand, aside from India, has been in China. And there it is a reflection of a lack of attractive alternative choices. Traditionally, Chinese investors, their definition of investment is buy an apartment. Their definition of diversification is buy an apartment in Hong Kong as well as in China. But real estate markets have been performing poorly now for the last few years. So to a degree, Chinese investors have been at a bit of a loss to what to do with their money. Gold has provided a very attractive vehicle for them to invest in, and also to give them an investment which is not denominated in the local currency. It's, gold's a neutral currency vehicle, so it's allowing them to hedge some of their very long exposure to the Chinese currency. So I think those are the trends that I'd say: increased financialization, emerging market investors often buying gold for domestic reasons rather than international reasons. And then, of course, the risk and uncertainty, which is triggering maybe the Western investors to come back to gold in ways they haven't seen before.
Okay. Well, that's very insightful. Now, we've talked about what's happening. If you were to kind of zoom out and look into the next decade, from a macroeconomic perspective, what structural development could shape how investors think about gold as part of the asset allocation? You said it should be part of the asset allocation.
Yeah.
How are you seeing it over the next 10 years? How is it seeming to be moving in that direction?
I can't seem to find my crystal ball. I must have left it in the office. But joking aside, I think the biggest trend that will determine how gold performs from an investment perspective over the next 10 years is not about gold. It's about the alternatives. If we get to a stage where government bonds, global government bonds, become a reliably negatively correlated asset to equities, like they have been for most of the last 40 years, but not crucially since 2021. If we return to that environment, then gold probably does fine. I mean, we will continue to see people investing in it, sometimes disinvesting in it, and other times. That's pretty much the status quo we've seen over the last 10, 20 years. But if investors become more concerned about the stock of government debt in developed markets, if bonds start to, or no, not start, continue to correlate to equities, then the fundamental building blocks of a portfolio, the so-called 60-40 or the 70-30, as I illustrated in this example, that kind of breaks down. I mean, the idea that you have bonds in your portfolio is partly for income and partly because they will help offset the risks when equities fall. That hasn't worked very well for the last few years. Morgan Stanley's chief investment officer put out a paper last year, which I particularly liked, and it discussed this change in correlations of bonds versus equities. And they said the conclusion of their paper was the 60-40 portfolio is dead. You should have 60-20-20. So 60% in equities or other growth assets, 20% in fixed income, and 20% in gold, potentially some other hard assets. Now, when we make the case for a strategic allocation to gold globally, we typically talk about somewhere between 5 and 10%. India's a bit higher for reasons I've explained before, but yeah, 5 to 10% historically is what we've suggested is the ideal allocation to gold.
Okay.
On average, globally, investors have about 3% of their portfolio in gold. So if we are going to get to a world where more investors, be they individuals, be they family offices, be they institutional investors, recognize the value of gold as a strategic allocation to portfolios, and if we move that from 3% to 4% to 5% over the next few years, never mind 20, then that's an entirely different market. And that's why I say it'll be the performance of government bonds, and therefore partly the performance of governments in reining in their spending and central banks for keeping inflation under control. And if you've lost confidence in both of those things, then I think gold allocations will increase, and gold will perform very differently in the next 10 years than it has done in the previous 10.
Yeah, that's very, very insightful. It gives a very, very different perspective. We tend to have questions coming in from a very shorter term perspective, but there is one area which people keeps on asking if you have an answer to it. As there are two commodities which they tend to compare. One is what's the silver gold ratio, which typically people talk about, and if there is any linkages between oil prices and gold. Would that, because oil prices are moving up right now, does it have any impact on gold? And the second is there correlationship between silver and gold? The reason people are coming in as a question here is more from an asset allocation perspective. Surely oil is not part of the asset allocation, but silver is.
Sure.
So is
Okay.
there
I'll talk
anything?
about silver and gold first, and then we'll turn to oil. First of all, we're the World Gold Council, right? So we talk about gold. We don't talk about silver very much, but
Right.
most of our member companies produce silver, and I've studied silver for many years, so I'm happy to talk a little bit about it. If you look at the performance of silver over the long term, silver's performed in line with and actually slightly underperformed gold over the last 20, 30, 40 years. It has much higher volatility and much less liquidity. So why would you think of it as an alternative to gold as a strategic allocation? Okay. You're buying something which performs at best over the long term in line with more volatility and with less liquidity. It's not a strategic asset. Okay, fine. That doesn't mean you can't make money out of silver. And you can see that over the last 12 months or so. And it comes down a bit to the problems about tactical trading. When the gold silver ratio is at 80 or 90 or even at 100, as we've seen on occasions over the last few years, silver's looked cheap compared to gold. But it needed something to encourage investors to pay attention to it and buy it. And we got that last year. We got that partly through tariff disruptions, moving physical metal from London, from India, from China, well, not from India maybe, it's certainly from China into the United States. And that tightened up a market and probably kicked off the outperformance that we saw of silver. When the gold silver ratio is at 80 or 90, I personally look at silver and think, that's cheap. It's probably going to outperform at some point. And if you can identify those factors, then you can tactically make a load of money. I had expected silver to perform well when the global economy picked up because it's got a much higher proportion of industrial demand. But it happened quicker than that because of the movements in tariffs. In general, when the gold-silver ratio is about 60, I tend to think of it as about it reasonably valued versus gold. And when it gets below 50, it's like, wow, that's gone a long way very quickly. Maybe I should be taking some profits. So no forecasts. We don't give forecasts. But I would say if you think about the range, if you think about, I don't know, 60 to 70 or maybe 55 to 70 as being a reasonable, fair value for silver versus gold, think about where we are in the global economy or the global economic cycle. Are we in a recovery phase? Are we in a phase when industrial demand is going to pick up and industrial users are going to restock? In which case, that ratio should be at the low end. Are we in an environment where the economy is slowing, maybe inflation's picking up, maybe there's an oil price boom going on because of a war, then you probably think silver's probably should be cheaper. In other words, that gold-silver ratio should be a bit higher. Oh, and by the way, when it's got up 140%, take some profits, because I know an awful lot of people that didn't take enough profits last year.
Yeah. Okay.
Versus oil.
Yep.
I can't imagine two commodities that are more different. As I said before, you mine gold, you refine gold, you turn it into something and it never goes away. You extract oil from the ground, you refine it, you turn it into a product, you destroy it. So these are very, very different commodities. I tend to think about oil versus gold as partly a measure of geopolitical stress, particularly when oil supply is involved, i.e. the Middle East. I think of it as a leading indicator for consumer inflation, potentially. I tend to think of high oil prices as a tax on consumers, mostly, and therefore negative for economic growth. Do I look at a ratio? Do I know where the oil?
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.